Year to date, Tesla's up 86% according to our software. Guys, are you really telling me that the value of Tesla is up 86% from the beginning of this year fundamentally? The hardest part of investing are the next two questions I'm going to ask. How do you find great companies, and when do you buy them? If it were so easy, then we'd all just sit out there, find great companies, buy them, and ride out into the wind. That's not the way it works. The market is a voting machine in the short run and a weighing machine in the long run. What does that mean? Well, what it means is, in the short run, the popularity of the business or the news of that company is going to drive the price. If people are bearish on it, they're going to hate it. If people are bullish on it, they're going to love it. The stock's going to go up. Let me give you a prime example. Let's look at Tesla. Year to date, Tesla's up 86% according to our software. Guys, are you really telling me that the value of Tesla is up 86% from the beginning of this year fundamentally? Their sales aren't up 86%. Their profits aren't up 86%. So somewhere, shape, or form, it was either overvalued or undervalued or something happened along the way. This is a reaction to short-term market fluctuations. But over the long run, you're going to see the true value of the businesses. Let's look at an example like Cisco. Look at Cisco. It's currently selling at $50 per share. Back in the year 2000, it hit $80 per share. And guys, it has never been there since. 23 years ago, March 23rd of 2000, 23 years ago next month, it has still never recovered from that to that point. Why? Because the market euphoria here was so intense that people thought Cisco was going to be the first $1 trillion company and there was no way of stopping it. And then what happened? Reality set in. What was that reality? The fundamentals did not support it. Let's look at the numbers. In the last 12 months, Cisco's brought in $53 billion in revenue and profit of $11.3 billion. Let's see what it did back when it was $80 a share in 2000. It did 10 to 15 billion in revenue and made between 1.3 and 2.5 billion dollars in profit. So the revenue is up 3.5 times and the profit's up 5 times. And the stock is down. If I told you back here that the revenue for the next 20 years, 23 years would be up 3.5 times and the profit would be up 5 times, where would you think the stock price would have gone? But it didn't. Why? Because of overvaluation. It was a company that made $2 billion back then and was valued at $500 billion. That's a PE of 250, when the market average over time is 15 to 16. Overvaluation. We can do this for many, many companies. In the short run, stocks are going to do whatever they want. So the question is, how do you find great companies? Well, I think there's a few ways to find great companies. So as you see, let's find a stock that's a 8-pillar stock for us. T. Rowe Price. Now, I'm not saying you should go buy our 8-pillar stocks. And if you like the software at the end of this video, we have a special running, $7 for 7 days. Go to everythingmoney.com and check it out. But these 8 pillars kind of give me a way of looking at a company and saying, what's going on here? So a couple of things. We want a high return on invested capital. Every value investor knows this is an important metric to look at. Why? This tells us, are they able to manage the cash that's invested in the business through debt and equity to get a good return on their money? A company with a high return on invested capital doesn't need to reinvest as much money to grow earnings. Think about it this way. If a company has a 5% return on invested capital and another company has a 20% return on invested capital, if each company wants to increase their profit by $1 billion, this company has to invest $20 billion to get there. This company needs to invest $5 billion to get there. Because $5 billion times 20% is $1 billion in profit. $20 billion times 5% is $1 billion in profit. This company needs to invest a lot less capital to grow their profit. And as they grow their profit base and it continues to grow, they can use that money to buy back shares, pay dividends, and do all the great things that'll make the company even better. That's the importance of return on invested capital. That is why we look at it so much. Now, another thing, lower debt. This is our long-term liabilities divided by 5-year free cash flow. What this basically does is we take all the long-term liabilities of the company and we divide it by their average free cash flow over the last 5 years. Here on our main page is about $2 billion. These guys can pay it in about 1 year, a little less than 1 year's time. Imagine your life. Imagine if you have enough cash on hand in your bank account to pay off your mortgage, credit cards, student loans, car payments, everything within 1 year. You're completely debt-free. Imagine that world. That's why we love that metric. Companies with less debt are going to stand the test of time a lot better. When things get tight and the economy does a hit, companies with less debt are more likely to survive. When interest rates go up, companies with less debt are going to be less affected by that. If interest rates doubled for T. Rowe Price, will it affect them? Absolutely. But will it affect them as much as if they had 10 times debt? No, absolutely not. That's the benefit here. A properly run business should not need debt to make better returns. Yes, debt will help you magnify returns, but it doesn't make your investment better. It just magnifies the return, the gains and the losses of the company. That's it. You go look back at history, and a lot of debt hurts people. Am I against debt? Absolutely not. I have debt. I have a lot of real estate. I have no problem borrowing, but I borrow reasonable amounts of money for my businesses and my investments. Same thing here with the company. Now, the biggest ones for me, I want the 5-year price to free cash flow and 5-year PE ratio to be low. Now, what's low? I don't know. Low is all relative. If they have a high return on invested capital and they have a reasonable growth rate, you should be willing to pay more money. For example, going back to our example before, if a company has a 5% return on invested capital versus 20%, two companies, everything else is the same, you should absolutely pay more money for this company. Absolutely. Why? Because they can grow their earnings much faster than this one and require less capital to do so. If you read Warren Buffett's annual reports, he always talks about See's Candies and other companies he buys, where he says, over 30 years, we've received $17 billion in profit from this business, and all we had to do was invest $1 billion to get that. That's what he's talking about there. He's talking about what kind of capital did the company need in order to grow their profit. That's super important for the world of investing. So that's what makes a great company. So how do you find them? Well, what we like to do is we like to run screeners, and our software is good for that. We sit there and we can go to our tools and our 8-pillar search, and we can decide which pillars we want that are important to us. Boom, we select them, and it tells us which companies have that. And it's just going to scroll down. You can start doing your research on all of them. Or you can sit there and do your pillar screener. You can actually select each metric and put what kind of ratios you want. Greater than, equal to, less than, PE ratio, 1, 3, 5, 7, and all these metrics. And this is growing like crazy. We keep adding more and more. And that's how you can screen out and find good ideas. The other ideas, guys, I get a lot of ideas from the EM community. I literally go in there and just see what people are talking about, and they make great arguments for some companies. One of the best analysts I have working with me is somebody that came in from the Everything Money community. These are the ways in which you can do this. It's super easy, and it's very useful because at the end of the day, this is how you find good ideas. And one of these good ideas can make you, depending on how much money you have, tens of thousands of dollars. I have no idea how much money you're going to invest. But the point is, these are the things that you have to sit here and look at to understand these companies. And over time, you read, you understand more about what makes a good company, and it'll allow you to go out there and find those companies that fit that criteria. Your job is to find a small amount of companies, 10, 20, 30 companies that fit your criteria out of the 10,000 that are out there. You can find that and hold them for a very, very long period of time. Try to find great companies that you can hold. The other thing is, there's a book called 100 Baggers. What a 100 bagger is the company you buy and goes up in value 100 times. How do you find those? Well, those are companies that are early in the cycle for some sort of industry and have high returns on invested capital. That is a very important metric, even more so than that 5-year PE and 5-year price of free cash flow. Why? Because those price of free cash flows and PEs can get very affected very easily early on in the business of a company. So if a company is very small and growing, that PE and price of free cash flow, I'm not going to say it's useless, but what's more important is, can you build it out where you sit there and see a high return on invested capital where they can keep dumping more money back into the company to grow it and compound that growth to the point where it starts to go parabolic. That's the key. And if you look at every company out there that has gone parabolic like that, they have done that. They've taken a high growth rate with a high return on invested capital and kept pumping money back into the business to grow it exponentially. That's the big key. Easier said than done. But like I said, that's why we have this community. That's why we have this software. So if you like it, check it out at everythingmoney.com. I guarantee for $1 a day, you're going to really, really be happy you did it. So thank you very much and check it out.